So you're considering purchasing or selling a property in the near future and want to know how the housing market will perform. Housing market forecasts are about as accurate as weather forecasts. No one can foresee the future with 100% certainty. However, we can look at what real estate specialists are saying and make some educated estimates about the future. Let's get into housing market predictions, what you need to know. Now, first of all, it is important that you remember that a housing market forecast may only offer you an idea of what to expect if you purchase or sell a home in the near future. However, you should never allow them to make housing selections for you. Only your own condition and budget should be considered. With that stated, let's take a deeper look at the current state of the market. 2022 housing market predictions. The housing market burst like pyrotechnics in 2021, and many of those sparks are likely to ignite again in 2022. Experts believe that a post-pandemic recovery is still underway. We're talking about stable mortgage rates, job recoveries, and the law of supply and demand, all working together to drive up house sales. Despite the strong demand and little inventory, buyers are still lining up to enter the house market. Keep in mind that when specialists analyze fresh data, these figures will most likely change. But the simple line is that in 2022, house sales will likely remain mostly unchanged and home prices will likely continue to climb, although at a slower pace than 2021. To put those numbers into perspective, the median house price in September 2021 was roughly $353,000, up nearly $41,000 from September 2020. Now that we've covered a nationwide housing market projection, let's take a closer look at the buyer and seller habits in each state. The key factors that affect the real estate market. Number 1. Demographics. Demographic data includes information such as age, ethnicity, gender, income, migration trends, and population growth to define the makeup of a population. These figures are often an overlooked but important aspect of determining how real estate is valued and which sort of homes are in demand. Significant changes in a country's demography can have a long-term influence on real estate patterns. The baby boomers, for example, are a demographic movement that has the potential to dramatically affect the real estate market. They were born between 1945 and 1964. The baby boomers' transition to retirement is one of the most fascinating demographic patterns in the previous century, and their retirement, which began in 2010, will undoubtedly be felt in the market for decades to come. There are a variety of ways that a demographic shift like this might impact the real estate market. But for an investor, some critical issues to consider include: how will this affect demand for second homes in popular vacation regions as more people retire? Or, if salaries are lower and the children have all moved out, how will this affect demand for larger homes? These and other inquiries can assist investors in determining the type and location of potentially lucrative real estate investments even before the trend begins. Number 2. Interest rates. The real estate markets are so heavily influenced by interest rates. If you're thinking about purchasing a house with a mortgage, it's a good idea to look into interest rates with a mortgage calculator. Interest rate fluctuations can have a significant impact on a person's ability to acquire a home. This is because when interest rates fall, the cost of obtaining a mortgage to purchase a property falls, resulting in increased demand for real estate and, as a result, higher prices. It's important to remember that as interest rates rise, the cost of obtaining a mortgage rises, lowering demand and real estate prices. However, when considering the impact of interest rates on an equity investment such as a real estate investment trust, REIT, rather than on residential real estate, the relationship can be compared to that of a bond. When interest rates fall, the value of a bond rises because the coupon rate becomes more appealing. And when the interest rate rises, bond value falls. Similarly, if the market interest rate falls, REIT's high yields become more appealing and their value rises. Number 3. Economy. The situation of the economy is another important aspect that influences the value of real estate. Economic metrics such as the GDP, employment statistics, manufacturing activity, and goods prices, among others, are used to assess this. In general, real estate is slow when the economy is sluggish. However, the economy's cyclicality might have distinct effects on different types of real estate. For example, an REIT with a higher share of hotel assets would be more affected by an economic downturn than an REIT with office building investment. Due to the sort of lease agreements in place, hotels are a type of property that is extremely sensitive to economic activity. Renting a hotel room may be viewed as a type of short-term lease that hotel clients can simply avoid if the economy is doing poorly. Office renters, on the other hand, typically have longer-term leases that cannot be amended in the midst of a recession. Number 4. Government policies. Another element that might have significant influence on property demand and pricing is legislation. For as long as they are in existence, tax credits, deductions, and subsidies are some of the ways the government may temporarily promote demand for real estate. Knowing about current government incentives can aid you in determining supply and demand changes and spotting possibly deceptive trends. For example, the United States government issued a first-time homebuyers tax credit to homeowners in 2009 in an attempt to jumpstart house sales and a slow economy. Only those who purchased homes between 2008 and 2010 were eligible. According to the Government Accountability Office, 2.3 million individuals took advantage of the tax break. This was a significant rise, if transitory. And if you didn't know it was due to the tax break, you could have concluded that housing demand was increasing due to other causes. Market home predictions for 2022. In 2022, it's likely that residences will continue to be snapped up quickly. Homes were on the market for an average of 21 days in September 2020, but now they're selling even quicker, with homes selling in an average of 17 days. This is fantastic news for sellers who are eager to sell their homes quickly. Buyers, on the other hand, must remain focused. You don't want to put off making a decision once you found the perfect home, since it will most likely be gone if you wait too long. That's why, before you get started, you need to know exactly what you're looking for in a home and how much you can afford. Predictions on foreclosures in 2022. While there has been a significant increase in foreclosure activity, evictions due to misused mortgage payments across the country, it is still below the pre-pandemic levels. Around the time the government's temporary restrictions on foreclosures was lifted in late 2021, the number of foreclosures began to significantly rise. Foreclosure filings increased by 24% in September 2021 compared to the previous month, and by 102% compared to September 2020. But compared to pre-pandemic levels, foreclosures are still significantly down, 70% lower. So, while a lot of foreclosures are expected to occur in 2022, the number will likely remain far lower than in a typical housing market. Housing market pricing predictions in 2022. It's doubtful that the housing market will collapse in the next years. Experts believe the present market is nothing like the one that existed between 2008 and 2010, when the last major housing bubble burst. This is why mortgage lenders are now required to follow tougher lending guidelines in order to avoid defaults caused by hazardous subprime loans. And housing supply is still extremely low, and it won't catch up for a few years, so there's no threat of home values plummeting. The bottom line is that as long as new buyers keep entering the market and there aren't enough houses for sale to fulfill demand, home sales and prices will continue to rise, and the market will remain robust. In addition to this, home prices are unlikely to fall anytime soon, certainly not in 2022. Some analysts believe house prices will rise at a slower rate, 7%, than they have before. Some believe prices will rise at a similar rate, 16%, as in 2021. Still, others believe prices will rise even faster. With this, you are left with one last question. Is it good to buy a home in the year 2022? If you're ready, 2022 might be an excellent year to purchase a home. If you're not prepared, it might be a bad moment to buy. Remember, don't allow the state of the home market to influence your judgments. When it comes to buying a home, your personal budget and life stage are the most important factors to consider. Whatever the market conditions are, you can only buy a property if you match the following criteria. Number 1. You've paid off your debts. Number 2. You have a reserve fund set up for emergencies. Number 3. Your monthly mortgage payments will not exceed 25% of your monthly take-home salary. Number 4. You have a 10 to 20% down payment. Number 5. You've budgeted for the closing fees. If you don't fulfill these requirements, it doesn't matter if the market is favorable to you. Buying a home now would be a financial strain. Take your time to improve your financial situation so you can buy a home the proper way. Hopefully, you have learned something from housing market predictions, what you need to know. See you on the next video.